Welcome, everybody, to the Chinchilla Pickin' Podcast. It is April 17th, 2023, 7:42 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined here by Brandon Beaver. Brandon, how are you, man?
How you doing? Doing all right.
Doing well, doing well. I would say it's been a light news week in stocks, but it hasn't. But it has. Lots happened since our last podcast. Lot to cover, really. I think a lot to cover from last time, like a recap. I will tell everybody listening, Brandon and I did not talk to each other this time ahead of time. I have no idea what he's going to say, and he has no idea what I'm going to say. We had zero conversation, but we are going to do a quick. If you're okay with it, Brandon, let's do a quick 5-minute recap of our last one and give some updates on what we said. If you don't mind, I'd like to start there.
Sure.
And just get right into it, just because there's a lot to cover and I want to get right into it and get going. So that make sure we cover everything, because some of these things are going to take just 2-3 minutes. And then some other ones, such as the earnings, are going to take 15-20 minutes, So let's start with some of these quicker things. I wanted to talk last time. We talked about the inflation report and what it was going to mean. We're trying to guess, okay, what was going to happen? What would this do to the market, and what's it going to do to invest in, right? I didn't think it was going to come in as low as it did. I was very surprised by that, but for me, that's a happy surprise because it presents an opportunity to go ahead and get in. I know in a group text I have with you and a few other people, I posted that, and you and other people both disagreed with me and said that, now's not the time to get in, even though it is showing much lower inflation than what we all thought. But you saw it as a precursor to a deeper recession and a hard landing. And I don't see it that way, but go ahead and tell me why you think it's a precursor for that.
So I said be careful. I said so we got to be careful.
My bad. You said be careful.
I said be careful. Usually recessions are coupled with deflation. As people start to spend less, prices have to come down on certain things, and you see large drops in inflation, or in other words, you see deflation. And so what we had a percentage drop. That's actually pretty big deal.
I believe it was a 1.1% drop.
Yeah. So it comes down to the fact that either A, people are spending too much money on gas and energy and things like that they need, and they have less money to spend on other things. It could also be that people are just running out of money altogether, which Jamie Dimon says that's not the case in the JP Morgan conference call, so that might not be it either. Or it could be that people are afraid of a recession, and therefore they're holding on to more of their money and saving more. But anyways, the point was, like, be careful with that, because that's such a large drop. It's better than expected, so to speak, but it may not be happening for the right reasons.
I get you. I think here's what I think, right? So we heard your thoughts on this and where you think it's the effect might, right? When I see this, I see that the Fed took drastic cuts, and it's just now starting to take toll, if you will, on the inflation number. But because the Fed took such drastic cuts all real quick in a row, I think we're going to continue to see this, but we might see the deflation that you're talking about on the other end. I think here's another thing. Here's the other thing that worries me is that we talked about this on the last show as well, was the fact that there was 1 million less jobs available month over month, and that was a huge drop. That was over a 10% drop in the amount of jobs available in the United States month over month. And that coupled with this huge drop could buffer your case and say, hey, yeah, this is a sign of deflation and we're going to have a hard landing in a recession. But it also, I look at it as maybe it's a good contraction that was much needed in the economy. I think we need to contract a little bit more. especially on consumer spending. Household percentage to debt. Like if here's the number. Let me see if I can explain this to everyday listener. Say a household has the ability to take out $1,000 in debt on credit limit, right?
Mhm.
Right now, they're taking out a higher percentage of that than they ever have before. And that's pretty typical of Americans. We tend to always try to push the limits on that. But it's also a scary thing, too, because if we continue to take out and max out our credit cards and max out our credit lines, and then you all of a sudden you now hit deflation, now you have a problem. Now you have defaults. And this is what I talked about in the fall of last year with the Apple credit card and worried about defaults. And we started to see that Goldman Sachs was losing money on the Apple credit cards because we're starting to see defaults in the credit card system because of Americans doing this. So I'm actually talking myself into agreeing with you when I wasn't trying to at first, but here I am. I'm agreeing with you. I think now the more I discuss this and talk about it live here on the show, it seems like yes, you guys are more in the right direction than I was.
I mean, potentially. I mean, this is so split down the middle right now, whether we're going to have a recession or not. Jamie Dimon says the storm clouds are still on the horizon. I think it was the BlackRock CEO that said that this recession just simply doesn't exist. It's not going to happen. And we have conflicting data. We've JP Morgan had great earnings. Citibank, Wells Fargo, they all beat. I mean, Citibank's earnings were still not that good, but they still beat expectations.
Well, I mean, look at Q1 for the banks. Q1 for the banks was tremendous. I'm sorry, but I mean, they all. I mean, if you didn't think that most of the banks were gonna beat in Q1, I think you weren't watching the market at all.
Well, it
You
was
weren't watching anything.
great for the big banks that capitalized the most off of raising interest rates. The regionals and sort of the startup, tech-based banks that got caught up in the tech crash, but then also like are suffering more because of interest, the yield inversion, the yield curve inversions and stuff like that. Not so much for regionals and not so much for the smaller banks, but for the big banks like JP Morgan and Goldman Sachs, they're raking in the cash for sure.
I tell you what, yeah, since you started going down that hole, let's talk about these small fintechs and these small regional banks. Well, not small. Some of these regional banks are actually
Let
kind of
me
big, but
let me slide one thing in real quick because you're talking
oh,
about the
go
Apple
ahead.
Card. So the Apple Card, if you're one of those people, you got, maybe medium subprime credit somewhere between like 650, 660, whatever, 675. Say you do have an Apple Card, and I'm not recommending getting one, but I do want to say this. If you get an Apple credit card, you have absolutely got to sign up for the Apple credit card savings program now. Maybe go out and get the credit card if it's not going to hurt your credit, that much. Don't use it. Just do the savings account because it's yielding 4.15% APR and it just launched today. And I think that you're not going to get that from a regular bank.
So, all right, if a couple of things here. There's a lot of things here I want to say. All right, I was holding off on getting into this, but since you open two bags, so I got to remember to come back to the fintech one. But we'll talk about this Apple savings account. Yes, Apple savings account 4.71%. It's a great interest rate, but you know who beat everybody to the punch in offering this high interest rate on the savings account, Brandon? Who is the really the forerunner, the leader, leading the way, making the change, and forcing these other banks to start making this change as well? Come on, Brandon, say it out loud.
Is it Robinhood?
Yes, it was Robinhood. Once again, Robinhood has caused all the private markets to start following their lead. They first want to come out there with zero trade commissions, and it forced everybody else to follow because they all lost consumers. Well, then Robinhood comes out and says, "Hey, we're going to offer this 5%, 4% yield on your savings account when you have a savings account with us." It took maybe 6 months now, and now Goldman Sachs, their Marcus savings account, you can also get that same yield, and Apple, you can also get that same yield. There's two big players in there now following Robinhood's lead. Robinhood has led the way in innovation
They're
yet
great
again.
at innovating. Learn how to make money.
Yes, they have trouble. They have trouble creating a profit, making money off these innovative ways, but they are changing the markets for everyday consumers, and I have to give them the credit for that. They have made it easier and quicker for everyday individuals to go ahead and start trading and investing, and now they're starting to go ahead and lead the way to make it easier for everyday individuals to get a high rate of return on a savings account.
They've got a retirement account now with a match on it that you don't need an employer for. So there's that.
Just wait 6 to 9 months, and you're going to see that somewhere else as well. Now, I'm telling you, they lead the way in innovation, but like you said, they don't know how to monetize it correctly. They're poorly run in that regard, but they come up with great, fantastic ideas.
If we had a hard landing this year, they were in great danger though with their balance sheet.
I still don't think we are, even though I talked myself into a possible recession right earlier in the show. I still don't think we're going to have a recession. I still don't think it's going to be a hard landing. I was very bearish fall of last year. I was very bearish, and maybe January this year I was bearish, but then I stopped and I said, no, I'm not seeing it. But like you said, we're seeing mixed numbers all across the board, different numbers here, different numbers there. There's too many mixed numbers for us to come up with a hard conclusion.
I mean, I thought it was going to be like raining blood from the sky. But as I've said 1,000 times, you don't go based on that, what you think your more macro opinion of the future is possibly going to be. That could be tainted for political reasons. It could be tainted, whatever, for ideology, whatever. It can be tainted. You go based on whether or not an individual stock is cheap or not. And if it's a good company that's cheap, you buy it.
Value, use the word you're looking for. Is it a value company?
Value. Yeah. I don't care if it's $5 a share. I just care if it justifies the market cap or not.
Right. And if anyone listening right now, there is an excellent article out there on the World Wide Web where you can find it. That's how old I am. The World Wide Web. You can find it. It's written by Brandon Beaver, co-host of the Chinchilla Pickin' podcast, and it's about how to value a stock or a company. Great article for this. Go read it.
Yeah. For all of our news, which we've had a plethora of in the past 2 weeks, people decide to start listening the minute I stop promoting the podcast. But we
right,
really appreciate it. I'm happy with it. It's fine. Great.
Yeah, and if you are new listening, we appreciate it, guys. Please hit the subscribe button. Please follow us, StockTwits, Instagram. We appreciate it. DM us anytime you have any questions. Reach out to us. We will respond as soon as we can. But just know we don't have a team of people here. It is just Brandon and I. We are growing extremely fast the past few months, and we're trying to keep up. But we are busy and we do have lives, and we're trying to do the best we can. We're just here to help you guys. That's all we care about. That's really all we care about.
I want to add a little bit. I don't want to complain too much about them because it's a great platform. But Spotify said that because of the followers that we have, enough of them weren't Spotify listeners. So they demonetized our ad, so you're not listening to it anymore. I just took it down. And I don't care. If you guys want to listen from Apple, if you guys want to listen from Spotify, Good Pods, Amazon, I don't care. I just want the listens. Me and Dave would do this for free for the rest of our lives if we wanted to. I might go out shop for other advertisers that would pay more anyways. I don't know. We'll find out.
We are open to advertisers. If you're listening and you want to advertise, please reach out to us. But for right now, you guys get it ad free.
Yeah, because they wanted to punish us because 90% of our listeners come from Apple Podcasts, but whatever.
Right. Let's just reach out to Apple. So I want to go back to fintech. Let's circle back here, if you don't mind. Fintech. You briefly touched on that. And so, guys, if you're listening, you don't know what fintech is, you don't know what we're talking about. So there's the big, huge banks everybody knows, the JP Morgans, the Citigroups, the Wells Fargo's, Bank of America's, right? Those are the big names, the big guys. Then you have regional banks, and these ones are not nationwide, not international. They are more like PNC, Key Bank, or Fifth Third Bank, right? Those are some of the regional bank names. And then you have fintech, and these are financial institutions that are online only, or just they don't really have too many infrastructure, too much infrastructure, too many office space. They are trying to find innovative ways to help you out without spending money on personnel and on office space. Some of these, I believe, would be SoFi would be a big name in the fintech. Now, There's a person that I was listening to on CNBC tonight, Brandon, and I know you're not very a fan of this person, but he did have a good comment about fintech. Talking about Jim Cramer. Jim Cramer was going to saying that the fintech space is too overcrowded right now, and that he would not buy any of these small fintech companies because you don't know which one's going to come out the winner in the end once the space consolidates. And that's what he said tonight. And I think that yes, he's right in a sense, but I think it's too early for consolidation in the fintech. I believe that people still are very excited about it, and it's still sort of newish. And I mean, look how long it took before the cryptocurrency space started consolidating. It took a number of years. I think we're going to still have a couple more years before we see fintech consolidate, but I believe he's right in theory.
You know what? I might go looking for some fintech companies to buy now. He's always 6 months too late. Where was he 6 months ago, when I don't know, or a year ago when these companies were hot and me and you were sitting there and saying, listen, if a company's not making money, tech's going to have a bad year. We said that at the beginning of 2022. Tech's going to have a bad year. It's going to be a really bad time. Get out of these tech companies that aren't making any money. And where was Jim then? And now he wants to say it now that it's all bottom. Here's the thing about Jim. Jim is great at at repeating what the market is doing for the day. That's like, okay, he's in the mood of the market for the day. And I'm not raining too much on what you just said, Dave, because I really actually kind of agree with it. But the fact of the matter is that I've stopped watching CNBC for the most part. Every once in a while, I'll get an article from their website or whatever. But I have probably doubled my investment skills as a result. I am so much better of an investor staying away from the daily mood swings that CNBC projects of the market on their television show. When really, if they're trying to teach people how to be good investors, they should be doing the opposite. Now, I was trying to find a notification I got on my phone. I couldn't find it, so I don't know where it came from. But it was something to the effect that Google sheds 20 billion in market cap value today because Samsung might drop them as a search engine.
Yeah. I know exactly what's going on with that. Yep.
That was less than 3%. But they chose the market cap value because it was an eye-popping number, right?
The hyperbole, yeah, it blows up the story.
To play off the emotions, which is actually something that you should step away from to become more rational so that you could be a good investor rather than panic.
And the funny thing about that story is that it said they might, because their contract's coming up. The contract's not up yet. The contract's coming up for renegotiation. So Microsoft has a chance to make a bid versus Google's bid with Samsung. That's all that is.
Pepsi and Coke. That's what it is. It's Pepsi versus Coke, and there's room for both of them, and there's room for both to grow. I like both companies.
Right, but your point is that CNBC blows things up, and they're just trying to squeeze in the ratings there. And yes, they're a TV, they're a media network. That's what they have to do. But it's also one of the few places, I will say this, it's also one of the few places as a day trader, I could get real-time information as it comes out quicker than really a lot of other places.
And now as a day trader, you can play off those emotions. So you can watch the market and then see, oh no, they're wrong about this or right about that, or they're overblown on, they're overdoing it on this, regard. So you can make money doing it that way. And CNBC.com does have an entire section on Warren Buffett that's absolutely phenomenal. So I will give them that, but.
All right, man. All right. So that's all I have for the quick recap of last week and where we're at now. I do want to admit I did get wrong the number on the inflation report, but I got it wrong in what I consider a good way. We'll see if it really turns out to be good or bad. But Brandon, go ahead. What do you have?
Oh, you caught me off guard here because we didn't have this discussion. Let me pull it up here. So
this is why we need to talk ahead of time.
I know. So the banks reported earnings last week, and then we also had the inflation money, number come out. a situation where we've got the conflicting numbers. So this is Jamie Dimon. He's talking in his earnings call. He said the U.S. economy continues to be generally healthy, and the consumers are still spending and have strong balance sheets, which surprising because we saw the inflation number come down. Which I do want to say, Dave, you mentioned inflation was contracting a little bit. In a way, it is okay, but the growth of inflation is what is contracting. Inflation itself is not coming down. We're not seeing deflation. We're just seeing the rate of inflation slowing, which is a good thing. But he said the storm clouds that we have been monitoring for the past year remain on the horizon, and the banking industry turmoil adds to these risks. Now for JP Morgan, revenue increased 38.35 billion from 30.72 billion a year before. Pretty good increase. They beat the earnings estimate of $3.41 a share and surpassed revenue of 36.13 billion. So I mean, just a great performance by them. You said you mentioned, Dave, that the big banks had a great Q1, and they did. Now regional bank PNC, by contrast, they dipped 2.9%. The stock did on lower than expected second quarter revenue guidance. First quarter earnings did come in at $30.98, beating $3.66 a share. So decent first quarter for them, but they warned that they were returning $1 billion to shareholders in the first quarter, including $400 million of share repurchases, and they expect to reduce share repurchases due to recent market volatility and increased economic uncertainty. So it's a reduced buyback program for them that caused the jump or the drop.
Now here, I got a question. Are they? Did they say whether or not they're going to reduce the buybacks because of the threat of taxing these buybacks by the IRS? And is that going to be a trend going forward that most institutions or corporations are going to stop share buybacks?
I think they'll stop the share buybacks if that happens, but no, they were just saying they're reducing the amount of buybacks because of the risk of a potential recession.
And so they as a bank, due to the 2008 banking crisis and regulations set up after that, they have to keep X amount of cash on hand to cover any amount of losses. And it worries me that these regional banks are like, hey, we got to stop spending here because we got to make sure we have enough on hand. So that tells me, like, why didn't you have enough on hand before? I don't know.
I guess being careful. They are one of the best run regionals, I think, but as far as even for the big guys, global deal making, and deal making revenue for the U.S. dropped 4% as far as mergers and acquisitions go, or IPOs, all of that stuff. And it was
that's more the bigger banks. And sorry, go ahead.
It was a very strong year for deal making in 2022, and this year not so much.
Well, that's because everybody's waiting on Microsoft to end their gaming deal.
Yeah, everybody's jumping in, and they should, because it's gonna happen.
When? Next year?
It might, but you know what? It's like next to guaranteed now. The EU okayed it. The Justice Department's gonna okay it. We're on clear footing here.
What percentage of return you're gonna get back? What's your ROI?
For me, it's gonna be a little over 20%.
No, if you bought right now.
I think it's around 10 or 15, somewhere between there.
10 or 15%.
Yeah.
So if I bought in there, I get around the same amount of return I would get on a mutual fund. So why wouldn't I just buy a mutual fund?
Do you know you'll get that on a mutual fund? That's the risk reward. I don't know. I can't tell the future. I don't know that the deal is going to go through, but I'm as close to knowing it as I possibly can be.
I got you. All right.
There's always
fair
a risk
enough
somewhere, but it's just a very, very small risk to make 10 to 15% over the next, 6 months to a year.
All right, go ahead. Continue with your earnings numbers. Hit me with them.
Wells Fargo, its first quarter profit rose to $4.99 billion, or $1.23 a share, from $3.79 billion. Must have made Warren Buffett pretty happy, other than the fact that the stock did dip 4%. Revenue grew to $20.73 billion from $17.73 billion. They were expected to earn $1.13 a share and have revenue of $20.09 billion. So a clear beat on both of those. Charlie Scharf, he's the CEO, said the first quarter results were strong. The bank is glad to have been in a strong position to support the U.S. financial system during the recent events that impacted the banking industry. I'm glad they're so glad to be on the other side of that. CFRA analyst Kenneth Leon, he said that Wells Fargo is a buy, and said the bank booked significant revenue growth in commercial banking of 42%. Consumer banking was up 9% despite a 42% drop in home lending from last year. That's a huge drop. 42%.
Very big drop.
So and we can talk about the, residential and commercial real estate. Listen, Europe right now, commercial real estate is just awful in Europe right now, but I'll get to that. Citi said its, and Citigroup reported, of course, Citi said its earnings for the last 3 months ending in March 31st increased to $4.6 billion or $2.19 a share, up from $4.3 billion or $2.02 a share a year ago.
Are they all giving good guidance here? Because they're all reporting good numbers. So are they all giving good guidance?
They're guiding very conservatively because of the potential of the recession, and everybody's kind of afraid, the Federal Reserve continuously raising interest rates, that more things are going to break and that we're going to see more turmoil in the financial system as a result.
So hold up. So basically what you're saying is they're in the same boat you and I are in, that there's just too many numbers that are off here, wrong right here, wrong there. And we don't get consistent information saying that it's all going to point in towards a recession or it's all pointing towards soft landing. We're going to be great. It's kind of a mixed bag. And so nobody kind of knows what's going to happen. And so they're being conservative is what you're saying. Yeah. So in saying that, that means they're going to be investing conservatively. So right now I wouldn't buy a bank.
I wouldn't either.
Because they've jumped up. I'm not going to invest in the bank now. They've already gapped up. They've moved up off these great earning reports, but they're going to be conservative. They're telling you they're going to be conservative, so they're going to be flat. They'll probably meet their guidance, but they're not going to beat their guidance for Q2 because they're going to be conservative.
Yeah. So April 18th, we'll see Goldman Sachs, Morgan Stanley. They had mixed numbers, but last quarter. But then they're probably going to have that again this quarter, April 19th, and 2 days from now. They're expected to have $1.72 a share earnings, down from $1.84 last year. First Republic is going to report on the 24th. That'll be an interesting one. But let's move on from banks real quick, because I was talking about the European real estate issue. European funds recorded outflows of 172 million euros.
Well, that's because people need to pay their heating bills in Europe right now.
Invested. So this is $215.4 million of money coming out of European real estate investments, and that was just in February.
Now, hold up. I mean, I cracked the joke about they paying their heating and oil bills, but like seriously, if Europe is seeing this outflow of money from real estate, and I think we're going to see that here in the United States as well. If I believe we've already started to see it in some of the commercial spaces, such as like strip malls and so forth, and that's just due to the economy slowing down, companies cutting spending, companies leases coming up and they're not renewing leases. So you're going to see a lot of office space, warehouse space, just sitting empty because they can't lease it out and nobody wants to invest right now because every major corporation is going to be conservative. So then you're going to see all these real estate, these rights. Again, I keep watching them, but none of them have dropped to a level that I would buy in at. All these rights start to drop and lower, and some may even fail. Some may, but it's an opportunity if you wait for the right time. But I also concerned about it because, the federal government said they were going to cut investing. They were investing in the mortgage buying mortgages at a rate of 20 billion a month, wasn't it? 20 billion a month in mortgages.
Yeah.
And so they've cut that down, but they have not cut that down to a number that they need to cut it down to. So they were inflating the market, and since they've tapered that, that may also be part of the cause is why some people are losing that funding that the government was given. So there's a lot of different variables here, but it doesn't look good overall for the commercial market unless the economy is able to have a soft landing. Then it should survive. But if the economy doesn't have a soft landing, then there's going to be a very hard landing for that sector.
So there's a lot of analysts that are calling for a 40% decline in European real estate stocks in the coming year.
Well, I mean, why wouldn't we see that in American real estate stocks? I don't see a reason why not.
It's possible.
NYMT, New York Mortgage and Trust. Why would you not see that just drop down to nothing? If it's even still around, I don't even know that company's still around.
With higher interest rates.
Boston Properties. There's another one. Where is that one going to be around?
I mean, it might not. I mean, higher interest rates are increasing the cost of borrowing, and it's depressing valuations. And I mean, it's not really depressing the valuations here in the United States yet, but it is over in Europe. You're seeing the results over there. And that's just like kind of the end game for us as well. I mean, that's just what happens when interest rates go up, the valuations go down. We haven't seen the valuations really drop yet. Home prices are still really high because nobody's selling at the moment, because nobody wants to move into another house and get 6% interest when they had it for 2.5% on the previous house.
Right. So let's talk about the valuations and how this all ties together, guys. So on the previous episode, we talked about Virgin and the space program they had there, right? Mm-hmm. And the fact that the Virgin space program, that company, I forget the actual name because there's two different Virgin space programs. And I don't know if it was Virgin Galactic and Virgin Orbit. Was it Galactic?
No, it was Orbit. It was Orbit.
Yeah, Virgin Orbit. That's the one that collapsed, right? Or it possibly going to get bought out now. Who knows? That company when it came out,
have they even done anything?
We discussed it briefly, and it was going to be like probably the hardware, the infrastructure, but
and the ticker, the stock ticker, which is probably worth more than everything they've done so far.
So when the company came out, it had that $4 billion valuation, right? Or I forget, it was an outrageous number, $4 billion valuation. And nobody could say what that $4 billion valuation was. A couple of years later, they realized that this company's not worth $4 billion, but they took out a loan based on it being worth $4 billion. So then they get margin calls, meaning, hey, it dropped your loan, your stock that you placed against the loan dropped below a certain amount. You now have to start paying some of this back. And they're like, we don't have the money. We're overstaffed. We're doing less work with more people than what we did 2 years ago. And so there was a whole issue there, but the valuation dropped and it caused margin calls and they didn't have the money to pay it. So what does that to do, David, with real estate and real estate valuations? Well, let's take this. If I open up 4 warehouse buildings, I build them up, right? And I go ahead and I took out a loan to do it, and I say, hey, these warehouses are worth, let's just say $1 million because I don't like doing math. So this is worth $1 million, right? And I can't get anyone to lease these out, and the real estate market drops. Well, now they're going to come in, they're going to say, no, those are worth $800,000 now, and you took a loan out saying they were worth $1 million. We may have to start doing a margin call on you and ask you to pay back your loan in full, or whatever collateral you use, we get to collect. And that might be what some of the issues you're going to see now with some of these commercials. If they can't get these places rented out, leased out, or the valuations drop below a certain amount because people take out loans based off valuations and, they sign agreements saying that, hey, you could do a margin call after it drops below a certain amount. Is that a good explanation for people who are listening right now?
It is.
And that's what we're worried about. But what Brandon also said was that we haven't seen valuations dropped like we think they should. And it's because people are just taking the properties off the market instead of dropping the valuation because they want to just sell it at a loss. Yeah. And so therefore we're not seeing valuations drop. We're just seeing less properties available.
Yeah, you may have a lot of home equity right now that you can cash in on if you sell your house, but you're going to spend every bit of it to buy another house at higher valuations with higher interest rates. So trying to sell your house right now, unless you're going to go move in with your parents or with a friend for, a year or two until valuations come down, trying to sell your house to buy another one, or even go rent when, the price to rent is so high. It just doesn't make any sense. So people are just kind of staying where they're at.
Yeah. I've seen that a lot. Houses come off the market that were on there for like 6 months that I was eyeing here just in Cincinnati. I was eyeing houses, and it's like, where did that house go? And it's still owned by the same people. They just took it off the market because
Yeah.
they weren't getting the price they wanted for. So it's a situation to look for in real estate. I see it as an opportunity. I watch these companies like EPR Properties, Boston Properties, NYMT, so on and so forth, and I say, hey, you know, have they dropped to a level to where I would think they are now value? And if not, then they just stay on my watch list and I don't buy them. But they are ones I keep an eye on. And I try to research and see what's going on with them from time to time. And I recommend anyone else, if you're interested in that sector, to go ahead and do the same thing. But the thing to watch is valuations. Have home prices, have real estate prices come down to an acceptable level to where we can continue to market like it was before.
Not yet, but then you also have to ask yourself the question, did the market front run a potential downturn? So I mean, honestly, I haven't looked at these US real estate stocks. So I have no idea how far down they are, or if they're down at all, to be honest with you. I'm sure they're
You mean
down.
like Lennar, KB Home,
Yeah,
all the of
exactly.
the big guys, the same
Right.
ones? Yeah,
Right.
yeah,
So if the market's front run those and then ran them to the ground, then it might actually still be the time to buy because, if it happens and it's not as bad as people think, then you might make some money.
right. I would love to see Zillow come down. That's just a monster in the field. They just have so many sub companies underneath that major company that just does all kinds of property. It's crazy what they do. They're just pushing everybody out of the game.
Yeah, they're kind of the Google for real estate.
They
Everybody,
are.
yeah.
Yeah, they really are. We
So
kind of
the
sidetracked this into a real estate
yeah,
discussion here. I mean,
yeah. Well, still, the European Central Bank is warning now. There's clear signs of vulnerability in the property sector. Wow. Uh, and they said that it's because of declining market liquidity and price corrections. Um, Pierre Graminga, think I'm saying that right. He's the manager director of the European Stability Mechanism. He told CNBC that something he would not overlook is a crisis in real estate, both for private people and for commercial real estate, where we see downward pressure both in the United States and in Europe.
hmm, there you go, downward pressure, man.
And I'm sure these banks are paying attention to that too, and that might be why they're giving these cloudy forecasts.
Yeah, because I mean, the real estate market has a huge impact. I mean, I'm more concerned about the personal credit, like companies like a firm, how their stock went from like $10 to $100 a share, and then back down to $10 a share, and rightfully so because they have so much subprime lending in a firm. It's ridiculous, like subprime. That I can't see how they're making any money unless they're charging absorbent rates like a payday and loan center type of thing. And that would be the only way they would work. I don't know. I don't use a firm, so I have no idea if they charge high rates, but it's just too risky of a business for me to invest in. And that was speculative investment. I know some people who actually bought a firm when it was first at 10 and there was talks of it going to be used by Amazon, and they made that 10 times their money. Great for them, but I was like, that's just too risky, man. Because what if they don't? It's just you're just going to lose all your money, you know.
Yeah,
So
I think it was used by Amazon.
yeah, it was and it still is. But the stock came all back down because they started reporting numbers, and it just it wasn't what everybody thought it was going to be. And I think it's just they had too many losses, if you will, too many people not paying the bill, and that's what happened. I don't know. I didn't look into it. I was never interested in investing in it. But if you are, please DM me. Let me know what's going on with it because
Yeah,
I still have no interest in researching it. I'm sorry, that's just my
I don't
opinion.
care either. I don't care either. It was that was the easiest call that we've ever made on this show. Was that tech and these highly valuated companies that weren't making any money, and fintech and basically everywhere in tech The space companies as well. That was like the easiest call. I don't even want to take credit for it. It was right there, right in front of you. Like if you've
I,
ever read
I'm
an investing book or an article or anything, it was so easy to tell this was going to happen.
I tell you what, look, I was bullish on SpaceX and Blue Origins. I didn't see the need for the other ones though. You were like bearish on all of them, but I was bullish on SpaceX and Blue Origins, and SpaceX actually is now they just launched a rocket again today that that eventually is going to take man to the moon. That is built and operated by SpaceX. So I still see I'm still bullish on SpaceX. It's just, it's a private company, so they're using private funds. They get some government grants. When NASA was sending people to the moon in the 60s, that was government money that was paying for all that, and they had a little bit more cash to work. They could just raise taxes, right? Yeah, just print some more. But SpaceX actually has to talk to shareholders and investors and be responsible with their funds. So it's taking them a little longer, but they're getting there. And that's the point I'm making is I'm still bullish. It's just a long term with them. I haven't heard anything from Blue Origins. I'm not as bullish anymore on them because what have they done? They had a couple.
I don't know.
They had a few launches and it was great, and then nothing.
They took William Shatner to space.
Yeah, they did. They did. Yeah, I mean, they had a few launches. It was great, and then nothing. So SpaceX is still the one pushing forward. That's the one leading the way. That's the one definitely leading the charge. So, I don't know. I'm still if that one ever becomes a stock, the valuation would just be enormous. I couldn't understand what the valuation would be on a company like that.
Add to that the fact that Elon Musk will not take SpaceX public until it's profitable.
Yeah, right.
So, it'll be a profitable company. So yeah, it's probably going to be a high valuation there. I would worry about getting into it after the IPO. I would want that to settle down a little bit first because it'd probably be pretty hot. Speaking of space, Lockheed Martin, they're building a series of satellites around the moon.
Oh, nice. That's what we need for that colony that's living there now, not now. So, nice. All right, man. Final thoughts, Brandon. Give us your final thoughts. Let us know if you have any calls, not calls. What you got?
Just be rational. Don't pay attention to the panic. Don't give in to panic. Don't give in to being like too super, ecstatic like the people who were into the space stocks and into fintech did, 2-3 years ago. But we're bearish. I mean, at least I'm still semi-bearish. I think there's a lot of numbers that have came out that have surprised me to the upside that I didn't expect. So there's a lot of positivity coming out as well that caught me a little off guard. But regardless, the point is if a stock is cheap enough in valuation, then you buy it. That's it. That's all. That's all. You don't worry about who's president. You don't worry about who you do or don't like. You don't worry about, whether you like Janet Yellen or none of that matters in investing. What matters is if you're going to make money. And the only way you make money is you buy stocks when they're at good valuations.
There you go. Talking about good valuations, guys, looking at the oil companies. So OPEC has said that they're going to cut output. We're not buying Russian oil, but Russia's selling tons of oil to China and India, more than what they sold before. All the what do you want to call it, tariffs or people not buying it? I forget. I'm drawing a blank on words here. But right, I'm no good with words. But when you look at the oil stocks, there's some interesting things that point out to me. Since oil prices is going up, you would think the oil companies would be a good buy. Yes and no. A company like Rig Transocean makes money off of rigs, oil rigs in the oceans, right? So if we're drilling less and we're doing less output, you would think they would not be making money. But yet right now, as of today, for today's only, Rig is the only one positive green on my watch list. Go figure. I wonder why that is. Schlumberger, they're the one that's a company that does repairs, service, parts for a lot of these oil drill sites and oil rigs and all these types of things. And if we're cutting output, why would that be a good one to buy? Why would that be a one that would be going up? That would be one I would actually be looking at to do a maybe even a put on. Rigs should not be going up. Rigs is still up there quite a lot. A year over the past 12 months, rigs up over 44%. It's a big jump, but rightfully so. The price of oil has jumped up a lot during that time. I don't know if these valuations on some of these oil companies is deserved. I believe that the rising waters lifted all ships, and some of them are going to go back down here soon. So that's one. That's a theory I'm working with, and I'm looking at as part of a swing trade, not a day trade, not a invest, but a swing trade with some of these oil companies. But that's my final thought, guys. So
wait. You know who's the winner in all this?
Who's that?
My man, Warren Buffett.
Because he has Occidental Petroleum. Yes.
Even I questioned it. You know, he was getting a good deal on it, but even I kind of questioned the timing of that buy. And well, he's right.
There you go. He was right. I'll give him that. All right, guys. As always, we hope you've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.